Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Brandon Cobb. Brandon is the owner of HBG Capital, a real estate firm providing investors with superior risk-adjusted returns and downside principal protection backed by real estate assets or real assets. In residential single-family sector of Nashville, Tennessee. Brandon was a former medical device sales rep before becoming a fund manager, managing $22 million plus of new first-time home buyer housing and build-to-rent communities. He was featured on the cover of REI Wealth Magazine, Realty 411 Magazine, and has been published in Forbes Magazine. Brandon's passion is developing unforgettable experiences with those he loves, and he seeks business as a tool to do just that. Brandon, welcome to The Wealth Flow.
Hey, thanks, man. It's great to be here.
Yeah, appreciate having you. And I really am excited to hear about your story and what you're doing with the single family stuff. But I like to usually start just with where you grew up and what eventually led you to real estate investing.
Yeah, I grew up in Memphis, Tennessee, a little suburb called Collierville, Tennessee. And if you told me 8 years ago we would be inventing these new communities for first-time homebuyers, I'd have looked at you like you had 8 heads because I had no desire to go into real estate. I actually never had a desire to even be an entrepreneur. I loved what I did. I don't have a corporate story where I was in corporate for 20 years, hated what I was doing, and had this dream, this passion. No, I was kind of thrust into it one Friday afternoon when my boss sat me down and told me I didn't have a job anymore. And that was kind of the writing on the wall. I'll never forget being sat down at Starbucks on that sunny June day, and you could smell the coffee. I was having a great day. I'd come off one of the best days you could have as a sales rep. I was over at Meharry Hospital. My trial went really, really well. It was one of those that you get excited to like tell your boss about things, right? And ended up getting let go that day. And that's when I learned that nobody was going to look out for my financial well-being but me. And so I said, well, I've got some money in the bank. I guess the worst case scenario is I can give this whole entrepreneur thing a shot. And if it doesn't work out, I can go back in the corporate world and get another job. And so that's exactly what I did. I ended up beating my 6-month ultimatum I gave myself. I said, hey, look, 6-month runway. If you don't make any money, just hop back in. No big deal. Ended up beating that by about 8 days. And I told myself, well, you beat it. So I guess you got to keep going. And I just haven't stopped since.
There you go. No, that's good. Well, either way, that's a quick transition, 6 months. I mean, you gave yourself, what would seem like an ample amount of time, but, that's a lot of time to kind of get things going. What'd you do from that point? Did you already have connections or know somebody that was doing this, or how did you make that such a quick transition into single family?
Yeah, I had like 4 or 5 different businesses I was trying to start, right? So as soon as I identified the strongest one, like I thought I wanted to be the next Tony Robbins. I was doing this life coaching thing, right? Young guy is 20 doing life coaching, right? Great idea. Lots of life advice I could give people. I thought that I wanted to teach people how to get in the medical device sales. So, something that I was good at. I had a track record, had a lot of people reaching out, thought there was a market for that. and had like an online motivational blog. I was writing articles and really enjoyed what I was doing. I was thinking, hey, maybe I can motivate some people. But real estate was the first one that showed a very clear path to making money. So I chopped off all of the other efforts and just focused on it. My first deal I ever did, I got by putting a bunch of those "We Buy Houses" signs up on telephone poles. And I had engineered off YouTube this like 8-foot pole where I could put the sign on it and it would like staple it up high so that the city codes department couldn't get to it. And I mean, I had like the police calling me. I mean, it was just absolutely ridiculous. But I didn't know what I was doing at the time. Again, right? Worst case scenario, just go back and get a job. But ended up getting a phone call off one of the signs maybe 6 weeks into it about a guy who was facing foreclosure, and he didn't have time to sell his house. He needed a cash offer. Went down, visited him, and didn't know much about repairs or contracting, but had met somebody at a meetup that was looking to get a house flipping business up and running here in the Nashville, Tennessee area. He was from Colorado Springs. His girlfriend at the time was going to school here at MTSU, and so he sort of had the secret Krabby Patty formula for this, and he just needed some boots on the ground here. And so I kind of said, hey, look, I got this gig here. How do we estimate the repair cost on this? And so he's getting bids and everything for it. And I sold all my retirement accounts, and I said, let's do it. Let's hit the go button. Ended up making about $30,000 on that flip and pretty much dumped it all back into marketing. And when I say just dumped it, I mean, if you've ever seen that movie Batman where the Joker slides down the big pile of money and lights it on fire, that's exactly what I was doing with marketing dollars. And so for the first 2 years, I didn't make any money. In fact, I lost about $111,000 in savings that I'd saved up. And I think that's when the real lesson in business started to take hold, when I ran out of all of my own money funding myself. The next 2 years, I paid myself about $35,000 per year just to scrape by, right? Like, single guy, no bad debt, really getting into it, and just funneled all the money back into the business. And man, that fourth year, things really started to take off. It's amazing what you can do when you keep reinvesting money back into the business, hiring people, paying for the right coaching, paying for the right mentorship, paying for the right masterminds, the group of people that are already where you want to be and where you want to go, and getting that path ahead from them and that advice. That's what really allowed us to catapult from there on forward.
Yeah, no, that's great. So you partnered up with this guy, and the first couple years, how many flips were you doing? What did that look like? Obviously, you got the first one under your belt. That one actually went really well, it sounds like, but just taking that entire profit and putting it back into marketing, which sounds like a great idea to be able to continue to fuel it. It just and I guess it was ultimately. So
yeah, the first 6 months, because I got fired in June, we probably did 4 or 5 deals. The next year, we ended up doing 19 deals. The year after that, we did somewhere around 35. Maybe even closing on 40. And the year after that, we were doing about 35, 40. So we built it up to doing about 35, 40 fix and flips or wholesale projects per year at that point, which was
that's great.
Not a bad little business that we were in. We got into doing new construction when we had an opportunity to buy a fire damaged home. The whole second story was crispy, man. But that first story wasn't that bad. And we had the opportunity to buy the home for less than what the land was worth. And we said, well, this has got to be a deal, because we could just scrape it and sell it and make money. So we said, let's get a structural engineer involved. Let's get the city involved. Let's cut out all the black stuff, keep the good framing, and let's just reframe on top of it. Keith, we ended up rebuilding and selling that home in probably 6 months. At the same time, we were rehabbing a property right around the corner, full gut rehab. I mean, down to the framing, down to the studs, skeleton there. We ended up rehabbing that property in about 8 months and selling it. At the same time, we ended up rebuilding and selling that other home in 6 months. We made 3 times as much money on the new build. And we said, why are we flipping houses? We need to be building houses. And so that was sort of the gateway drug to starting to do new construction and starting to do development at that point.
Yeah, that's neat. Yeah, it's kind of amazing. It is a lot easier, it seems, if you can start from a clean. I mean, even when you talk to different contractors, you're going to get better bids when they're doing stuff where, they don't have to work around what's already there. They can just do it at the appropriate time. But yeah, that's neat. So you did that one. You saw the savings, not only in time, but just the additional amount that you were making. And then when did you decide to go all in on new construction?
I mean, it was at that point when we saw that, we said, why are we doing rehabs? We had done a good job seeing the writing on the wall. We had all of our key performance indicators for the house flipping company measured. We knew exactly how, what our response rate was on our mailing campaigns and a lot of our marketing efforts. We had that measured. We knew exactly how many incoming phone calls that produced, how many were qualified, how many appointments we were going on from those, and then how many contracts. So we had a pretty good funnel to tell us how things were doing. We were also measuring our cost per contract, and the writing on the wall was there. I remember when we first started, our cost per contract was probably $3,300. It went up to $6,700. I remember when I was going on 1 out of every 5 appointments and getting a contract, I was going on 1 out of every 12 appointments and getting a contract. And then the response rates were going out. It's getting too saturated. The data was telling us it was getting very saturated. It was getting harder to have success. And so that combined with the lower barrier to entry with new construction, really, it was a no-brainer for us. We also had our own general contracting company. That evolved out of a need to be able to control these projects better, control the money, making sure it was getting to the right place. It was a level of risk that at the time we didn't want to take. And so we created our own general contracting business, hired the project managers, dug through a lot of dirt to find the gold when it came to subcontractors. And so we had vertically integrated out of a need. And so when things really took off was when we were kind of spread out. We were doing maybe 18 new builds at a time. And we're like, man, wouldn't it be nice if all these new builds were on the same piece of land? And all we had to do was show up to 2 or 3 sites instead of our guys being spread out, showing up to 18 different sites. And we said, oh, that's why these national home builders are doing this. There's economy of scale. You get better pricing. It's much more efficient. They go faster. And especially when you do these, cookie cutter copy and paste homes that we like to do for these first time home buyers, it becomes very easy to build them very efficiently. And so at that point, we said, all right, it's just as easy. Another light bulb moment like the new build. It's just as easy to talk to somebody who has a piece of land where you can build 1 or 2 or 3 houses as it is to talk to somebody who has a piece of land where you can build 50, 100, 200 houses. And so we, again, just redirected our efforts from these tiny little onesie twosie home lots to these 50, 100, 150 plus unit lots. And again, we wanted to add value, and we learned we could do that by pulling up a chair on the same side of the table as the city and working with them to help create the community that they want, listening to them going, hey, what are the problems here? What's lacking in the community? What are the parcels or where are the areas that are not the highest and best use currently? What do you guys want to see? And then reverse engineering that to try to help build the vision that the city wants. When we did that, all of a sudden it became a lot easier to go and get these parcels of land approved for the amount of homes that we wanted because we were in alignment with the city, not coming at them, shoving something down their throat that they don't want. And so we really did a good job there of giving the city what they want, which in turn allowed us to get what we wanted. And in the process, we learned that you can create a huge safety net for yourselves and your investors by force appreciating the value of that land through a rezone or taking it through entitlement and building it in. And that might sound kind of funny, but all we're doing is, let's say, taking a farm. A farm is going to be valued by a certain amount of money, how much income it can produce, and putting 50 to 100 homes on it, which is going to produce a lot more income when you sell all those homes. So we force appreciated the value of the land before we bought it with our capital and our investors' capital. That built in a huge safety moat for us while we're doing these projects.
Yeah, no, there's a lot there. So just to kind of go back, so initially when you decided that that new construction was going to be the way to go, you kind of took what you were already doing, trying to find these homes to potentially flip, but now started saying, well, let's focus on vacant land. We'll focus on lots. So you started getting them all over the city, which that could be a bit of a challenge. And then you had that another light bulb moment where you were able to say, well, wait a minute, let's actually look at a larger piece of land that we can put these on, and I'm building them all in a row. And I think you're exactly right. It's just as easy to have that conversation with that person as it is with the person that owns the lot. And then tell me a little bit more, maybe put a little more color on what you did with the city, because I think that's an important piece that sometimes gets missed. And I think there's a lot of opportunity there. How did you pull up that chair with the city and really get in there and, ask them exactly what they were looking for? And, I look at that as well on some of like the parks and things. I mean, there's a lot of parks. We're in the mobile home park space, and there's a lot of parks that get violations, and that they're trouble. They're pain in the neck for the city, right? And so that's an opportunity to be able to go in to the city and say, hey, where are those areas? And is there some potential there that this may need to be able to change hands? And they can kind of help grease the skids on that for you. But what did you do to kind of get on the same page as the city?
Yeah, just go meet with the planning commission or the liaison. Usually there's somebody there that is willing to talk to you. The council members, the ones who are in charge of approving things, go take them to coffee. That's all there is to it. And if you're working in some of these bigger, larger cities, it can be a little bit more difficult to do that if you're, going to downtown. The major metropolises, everything's kind of set in stone there, right? The bigger bureaucracies, that personal touch isn't going to go quite as far. You're kind of a cog in the wheel at that point. Like, the parcel of land, meeting with the district councilman who's in charge of that district would be probably a good idea to see if they're going to have support for that. That might be a good starting point. But as far as getting things done, there's a lot of laws and regulations with major, I'm talking about like, New York City, Chicago, spots like that, where it's going to be really hard to do this. For us, we're focused on entry-level housing. So, everyone talks about the affordable housing crisis. There's not enough first-time homebuyer housing. You got 33% of the home buying population, which are millennials at prime home buying age, chasing 10% of the homes that are being built. We just don't have enough of it. I'm focused more on the suburbs where you have the ability to create that entry-level housing, right? Because a lot of that demand after COVID pushed to the suburbs outside of the cities because of the work from home concept and not having to go into the office. So those local communities are much more accessible than your larger, more dense cities. And so just go and show up, put a name with a face, take the council members to lunch, meet the mayor of the city, and get to know the community. That's a big, big step in being successful.
Yeah. And your projects and where you're kind of focused, you're based out of Nashville. So what are some of the surrounding areas that your team is focused in?
Yeah, we do a lot in the Dixon County area, Dixon, Tennessee. We've got a lot over towards that area. Rutherford County, Murfreesboro. We've done some successful projects there. Montgomery County, Clarksville, Davidson County. We were doing a lot years ago, right? The downtown kind of Nashville core, but things just got too expensive. It kind of pushed us out of that entry level price. And the codes department and the infrastructure that the city had in place for like approvals, the city grew a lot, but the city did not do a great job of staffing people appropriately at the codes department, the water department, the fire department. And so you have all this growth happening, but the same amount of people in charge of managing it. And it became a big, big pain. So we kind of moved out to the suburbs after that happened.
Yeah. Well, that makes sense. And even the suburbs, continue to get fueled by the growth of Nashville anyway. So it's a great spot for that. And then, your focus being affordable housing and first-time home buyers, it's a good spot for that as well. So that's neat. Tell me a little bit about the land. You're finding these pieces of land, and remind me again about how big. I'm sure it varies depending on project and depending on just who you're able to find that's willing to sell. But then from the time that you work out a deal with the owner, you purchase it. Now you're having to kind of change the use of that. Tell me a little bit about what that process is like.
Changing the use of the land. So again, it starts with working with the city, right? Identifying the vision community, listening to the pain points, understanding the areas that they want to focus on, and then really hyper-focusing on this. As far as the process goes, here's what we do. And if somebody else were to want to do this, this is what I would recommend that they do. One is ask the city who they recommend for civil engineering. Your civil engineer is going to make or break you. This is a big trust thing. You're not a civil engineer. I'm not a civil engineer. We really do have to trust that they have made the right decisions. I had a civil engineer who was off like 6 inches one time on how much dirt we had to remove on 6 acres. And it cost me like $300,000 after having to remove everything and readjust the sewer and everything, like bring everything down. Lesson learned on that one. So make sure you get a good civil engineer, and the cities will know who that is. The next step that we do is after we find a parcel we think is a good fit, you want to make sure that you can add the density. Sewer equals density. If you have to do a septic system, you have to make the lots a whole lot bigger. So it's very hard to add density. So you really want to have sewer close by that you can install. After we've kind of checked some of those boxes, we'll have the civil engineer drop a concept plan where they just kind of put these houses on the lots, see how they lay, get a good idea of what we can actually put here. And we will go bring that to the council members and we'll ask and say, hey, just want to get some feedback here before we go down this rabbit hole with this seller. Is this something that the community wants and that you would support? And they can kind of give you, verbal feedback. They're not allowed to say like, yes, you have my vote. They're not allowed to do that, but they can give you some feedback like, I really like this. This is good. I bet this would be supported. Or no, we really need some commercial over here. Actually, we don't want this site for multifamily or for houses. We want to do it for industrial or something else. They'll give you good feedback on it. And after you have a concept plan that you're like getting thumbs up on and people are excited about, now you can start your due diligence process. And you always want to have a few different things to make sure before you start spending a lot of money designing the development. That's what's going to take a long time and take a lot of money, which is paying that civil engineer to draw out exactly where the water is going to go, where the sewer is going to go, what's the slope of the road, where the dirt is going to move and where. That's what's expensive. And you only want to do that after you've got that concept plan verbal with the city and you have a geotech report, a phase 1 environmental, and endangered species report. So the geotech just tells you what's underneath the ground. Is there a sinkhole? Is there some rock? Gives you a good idea about what the costs are, could potentially be. If you're going to hit rock, costs go up. Your phase 1 environmental tells you, hey, is there any toxic waste on here? Was it a dumping ground? Did a business that maybe changed oil or something that could possibly seep into the ground, was it here? You want to make sure that the land is not contaminated. And then the endangered species report. I had a friend of mine in Florida that was building some storage units, and they, before they bought it, they did not do an endangered species report. Come to find out, kind of get into construction, that there are these very rare endangered turtle species. And it cost them $40,000 to move those turtles to a different habitat where they're not disturbed. It was like 6 turtles. So get an endangered species report. After you do that and you're starting to work on your civil plans, you'll do like you want to get the preliminary approval. And so very light civil work, layout of the lots, and that'll go to a vote. So you'll show up to a hearing. Usually the first thing is kind of like a neighborhood hearing where you go present it to the neighborhood. You'll get feedback. Basically, they'll tell you how much they hate you and how ugly your baby is, usually because it's the people who live close by that don't want construction. Sometimes there's some people that show up, they're excited about it. And they're like, oh man, we need some retail strip centers or, more, we need some more tax revenue. But for the most part, it's usually people who are not a big fan of developers. And so you got to try to work with them and try to appease them as best you can. But it's like hey, we're here and, we're coming to the community, and you usually have some easels set up with some pretty pictures where you can see what the concept is and what it's going to look like. And we like to try to add some extra numbers on like, hey, tax revenue for the city, all this kind of stuff that the city's going to benefit from, a dog park, playground, etc. New commercial buildings. And then it'll go to the city, and the city will usually send comments back like, hey, before we have like a live hearing on this, here's some comments back. And so you'll take those comments and do the best you can. They might be like, well, we want a dog park here, just to let you know, we'd really like that. And then during the hearing, you got to be like, well, I can't do a dog park, and here's why, if it comes to that. And so once you get it preliminary passed, you've passed it at that point, right? This is if you've got it zoned, of course, already. If the zoning's already there and you're just trying to entitle it, you're good. You've got a preliminary plat approval. That means that this thing is going to be what you said it is. At that point, you're now ready to spend a lot of money and start designing this thing, getting your civil drawings in place. And so at this point, there's going to be a lot of back and forth between the city's civil engineering team and your civil engineering team that you've hired, making sure that it checks all the boxes. Your civil drawings will go and get blessed by the water department. They'll get blessed by the electrical department. They'll get blessed by the fire department. So all of these departments in the city are designed to keep the community safe. It's designed to make sure this is a safe development. And so after your civil engineer has wheeled it off all these departments and nobody can find anything wrong with the design, the city will stamp it. And they'll say, hey, this is final approval right here. Your plans are good. And then it gets submitted to the state. And once the state reviews it and stamps it, you're good to go and pull a grading permit.
Okay. Yeah, long process. What from a time frame, start to finish? I get it that it's going to vary, and as problems come up, that can vary significantly. But on average, what is the entitlement process, and getting it to that spot where they're approved and ready to break ground?
For us, 6 months to a year. It could go a little bit longer than a year. Depends on what's involved. Depends if you have to rezone it or if it's already zoned that way. And it depends on what you run into during the civil engineering design process. We had one take a year and a half because we went through 3 different iterations of the civil drawings before we found one that fit and was most cost effective. So sometimes it can take some time and some redesigns to really get the civil drawings right. And depending on what you're trying to do with the land, you might run into some obstacles, right? Like that's the 6 months is kind of clean. Like we got out scot-free, didn't have any issues. Year and a half, we ran into a lot of problems with the design and the different departments having to sign off on certain things, right? Because the fire department's looking at it going, well, how close are these houses going to be to the power lines? The water department's going, oh man, there's not a lot of water capacity in this area. We need something extra installed, right? Or maybe there's a pump station. Maybe you're sloping down and you've got some homes or some buildings at the bottom of the slope and you need to install like a pump station that's going to pump everything up. So there's a lot of things you can run into. The biggest factor though is going to be your municipality. Here, I like to complain about a 6 month to a year process. And I like to just, everybody likes to complain about the problems. And then I talk to developers out in California and they tell me, Brandon, it's 2.5, 3 years sometimes before we get approvals. And I go, what? I go, well, how do you convince the seller to go under contract that long before you buy it to get your approvals? He goes, we don't. I said, what do you mean you don't? He said, we buy it. And if it didn't work out, we try to sell it and hope we don't lose too much money. That blew my mind because we would never buy something without having all the approvals in place. That's just extremely risky. And so the area that you live, city that you live in, and the local municipalities in and around your city and the different suburbs, they're going to be the biggest influential factor on how long it takes to get these approvals.
Yeah, yeah. No, that's huge. It makes a lot of sense. And yeah, that's huge. So you mentioned not closing on the property until, so you're not having to, you're doing some initial investments, obviously, with all the stuff that needs to happen. But when you actually close, when you can break ground.
Yes, once all the approvals are in place and we have bids on the civil drawings. And so as a developer, you're kind of rolling the dice a little bit because you know what your past development costs have been, you know what you can buy it for, you know what you can sell it for, but you're not 100% sure what your development costs are until you have civil drawings that have been approved and you have bids on that civil drawing. It's the same thing with a house. You can say, hey, what's it going to cost to build a house? And you kind of know based on some past houses you built about what the costs are going to be. But until you get those architectural plans and the specs from whoever's telling you to build it, you don't know what it's going to cost exactly to build that house. And so we don't close on it until we have all of our budgets lined up, all of our bids, all of our approvals in place. And usually we try to have an end buyer lined up as well. So I want to eliminate as much risk as possible while I'm going through this process of force appreciating the value of the land.
Yeah. Okay. And what about like earnest money for the seller of the property? Is there a spot where that's going hard while they wait out this process? I mean, obviously they know you two are spending quite a bit of money and time invested in it, so it's in everybody's interest for this deal to go through. But just curious how that's set up usually with them.
Yeah, we're very open and honest with the sellers about what's going on, and in fact, that's part of our value proposition. And we don't have to talk to a ton of sellers per year, luckily, because we have such a compelling value proposition. We're going to people who have a piece of land, maybe it's worth $500,000-$600,000, and going, hey, if we could offer you $1 million for it, would you be interested? And they're like, well, yeah. I mean, how are you going to do that? Deal of a lifetime, because they know another consumer is not going to buy that house for that much. And then we explain the process and what's needed. And we invite them to all the hearings to show up to, everything, so they feel like they're a part of this process. The only time we release the earnest money is if things are taking a little bit longer than normal and they're kind of getting antsy. We'll say, hey, look, we need another 6-month extension. Here's $20,000. And then they'll be like, okay, all right, I'm good. Let's keep going.
Yeah. Yeah. No, that makes sense. As long as they know in advance, kind of what the process is, I could see how they would be okay with it, and they're getting a premium for their land as well. So.
Expectation management.
That's right. Exactly. And so with the home building itself, once you've done this, so again, that you're doing all this with the land, then you're going to be building these homes. Now, are you building to sell, or is it all build to rent? I know at least part of what you do is build to rent. But tell me, is that the whole concept? Is
Yeah, so it's a mix. We've got 4 different exit strategies right now. That build to rent one, man, it's been tough to get stuff to pencil since interest rates come up. I'd love to be able to hold on to more assets. The interest rates really made it difficult to do that. But we've probably got 600 units in the pipeline right now. I'm not going to build 600 homes. I don't have the capacity, nor I have the financial means to do that. So we have these 4 exit strategies. Exit strategy number 1 is we get all the approvals in place and we buy it, and then we just sell the land to another developer, right? Say, hey, look, you take it, make us a good offer, and ourselves and our investors, we make out good, we're happy. That's kind of the fastest way to the money. Exit 2 is we develop and sell it. So this is where a builder comes in, is like, hey, if you could develop this for us, I would love to buy this land from you so I could build some houses on it. These are typically the Lennars, the DR Hordes of the world, the national home builders. And so we will syndicate that deal. We'll raise money from investors, and we'll put the roads, the utilities, the infrastructures in, make it a community, and then sell it off to some builders to go build on it. That's exit strategy number 2. And then the third is we'll actually go in and we can build the homes and sell them if need be, because we build as well. And then if for whatever reason that doesn't work, we've sold stuff to build the rent funds before, and we've also got the ability to look at it if it pencils to actually hang on to it longer term and do build to rent out of it. So we've got 4 different exit strategies.
Okay. And yeah, that makes a lot of sense. What about when you're selling to a developer? Kind of give us a breakdown of that. If I'm an investor, for instance, and we're putting money with your group, and when is the investment actually being made? Is it being made when it comes time to close on that land, and then what's the typical hold period? If it's going to be, for instance, an example where you don't intend to do the building, but you intend on doing the development side of it and then selling it to one of the larger home builders.
So on exit strategy number 1, let's say that we just want to sell it to another developer. A lot of the times we've already lined that developer up in the event that once we get all the approvals in place, we can then sell it to them. So we could double close on it. We could just assign the contract to them. There's a lot of different ways to do that. But typically when we're getting investors involved is when there's a lot of development around and we're getting a really good price for it. And we buy it and we want to wait a year or two because we know that the prices for those lots for that land is going to skyrocket. It's like if you look at a parcel map, it's a bunch of puzzle pieces all kind of pieced together, right? You're looking at all the little land parcels and they all connect with each other like a giant connected puzzle. And there's these big parcels of land and there's a bunch of little bitty itty bitty little puzzle pieces around it. That's where the density is. And so you know that the value of this land is going to go up significantly if there's already a lot of development around it. Also, if you're the guy putting in the sewer and you're running it down a road and all of a sudden all these other parcels have sewer that didn't have sewer before, that's a huge value add play. That adds a lot of value to it. You don't have to spend the cost doing the sewer. And now you can make a lot more homes fit on these parcels where they couldn't before. So we'll look for parcels where it makes sense to hang on to it for a year or two with our investors and just let some of the development settle down and then sell it at that point. Number 2 is we're always lining up developers and builders and seeing what's going to be the best offer we can get for ourselves and our investment partners. And so if we get a deal that's just really good to say, hey, like we're doing 74 pads right now for a developer. They offered us $85,000 per pad and they put down several $100,000 of earnest money and said, here you go. And our all-in costs are like $61,000 per pad, right? I like those numbers. Those are really good numbers. I'm like, okay, there's plenty of margin here. I'm making, $24,000 on a $60,000 per pad investment times 74. All right, I like those. Those are really good margins. We've got a lot of interest here. There's a lot of demand for these lots. Multiple builders want to buy it. I feel good about doing the development here. Let's go ahead and develop and sell this land. And then typically if we're building the houses, it's the same play. We're looking at the absorption rates. We're looking at, how fast the homes are moving, our capacity as well, and looking at how much capital we currently have available. Typically, I want to be able to do all 3, and as each exit falls through, be able to fall back on the next exit.
Yeah. Oh, that makes a lot of sense. That's really neat. That's kind of cool because it's different than a lot of things. You've got so many different possibilities there to be able to exit. I love the idea too of just the double close. I've heard a couple different guys doing something similar where they just got the piece of land up to the spot where it needed to be, and with every intention of continuing, but then we're able to sell it and came out really well with it. So that's neat.
Yeah, it's worked out really well. I think it's one of the best kept secrets in real estate. It definitely doesn't get the attention that multifamily and some of the flipping single family houses, it doesn't get that kind of attention, but land is the foundation of all real estate. And, one of the biggest problems we got right now is getting enough homes in the market, entry level housing. And so we want to be in areas where not only does the area, does the city, does the suburb have lots of growth potential, there's a lot of money pouring into it. I love Nashville because God, we've got 4 like big streams of income coming in. You've got institutions pouring money into it. You've got large corporations like Amazon, Alliance Bernstein, Oracle, Nissan have come and set up shop here. You've got a lot of small businesses that are moving here as well. And you've got consumers, right? Like one of the top 10 fastest growing cities of the United States. Money is moving into the area. That's what you want to see. And then from an asset class standpoint, you can't build enough of this entry level housing, right? People need something that they can actually afford. That $2,300 to $2,600 per month mortgage payment is really what these millennials need and what they want. And there's just not enough homes being created for that. And it all starts with land. Land's the foundation to deliver all of this.
Yeah, for sure. And so from an investor standpoint, on the ones that you're going to develop, or really any of them, are you doing any kind of distribution throughout the process, or is it basically they're putting their money in and the plan is to get X on once the development sells?
Yeah, there's no cash flow when you develop, right? It's not like multifamily where you have rents coming in, and so they're getting their principal and accumulated returns when we sell the project, basically. So not the best fit if you're somebody who's looking for like monthly or quarterly cash flow. This isn't for you. This is more of like, let's build some wealth here and keep your capital, parked somewhere where it's going to be secured by a lot of equity for the time being.
Yeah. And as far as and just whatever you can or can't, but just some examples of kind of some exits and what do the numbers look like from a multiple standpoint?
Yeah, great question. So I'm a simple country boy. These sophisticated waterfalls and GP splits that we do, I keep things simple. So what we've done in the past for our investors that we've been able to deliver on is we just do an 18% pref, and it's 100% waterfall that goes to them until they get their principal and returns back. And so that's annualized. We don't make any money or profits until all the investors are out of the deal first. And so that's what's worked out really well for us. Probably leaving some money on the table, but I like that. It works really well for us. Equity multiples, it's interesting. So we were doing a combination of equity and debt before interest rates went up, and now up to building the homes, it's really 100% equity from investors. And so we're able to come in, own the land outright, not have to worry about some bank calling the note due on us. I've bought land that we sat on for a year and a half and, couldn't develop because there was no buyers. Interest rates went up. Everybody freaked out, but the market bounced back. But because we were able to hang on to it and weren't forced to sell, we were in a great position. And so that's what I want to do. I want to continue to be in a great position like that.
Yeah. I like that. That makes a lot of sense not to have that debt. And then, you're not burning. You don't have this amount that you're burning every month just because maybe it took a little bit longer. Obviously, there'll be a little bit with taxes and stuff, but not something dramatic. So cool. Well, I'll tell you what, Brandon, I've enjoyed this. This has been cool. I always love hearing how different people are structuring deals, and this has been really neat. But tell us a little bit more about how people can find out more about you, if they'd like to follow you, if they'd like to get involved with some of your projects. How do they reach out to you?
Yeah. So if you're somebody who's interested in learning more about diversifying, with land and entry-level housing, there's a ton of free resources we have. If you're interested in trying to build a legacy or, making an impact or ultimately trying to build and retire, you can go to our website, hbgcapital.net. That's pronounced Harry Bob Gary Capital.net. I joke someone stole the .com, so it is .net. But we've got free resources on our website. We've got an ebook, 100 questions business owners ask before investing. I wrote that ebook after I got a phone call one day from an investor who asked if I'd be willing to take a phone call from one of his friends who lost all their money lending it to a real estate guy. And it became very evident on this phone call, the reason he lost all his money was he was green and he didn't know what he was doing. He did not have the right paperwork. It was not secured. He didn't do the homework on the operator or the sponsor. Just disaster. And so I put together that ebook in an effort to, if I could just prevent that from happening to one other person. Questions give us the answers we need to make more informed investment decisions. And I'm confident that had he asked these questions in this ebook, he would have gotten the answers he needed to make a more informed investment decision, and he would not have lost money. So you can grab it on our website, hbgcapital.net. We've also got a podcast, recession-resistant real estate radio. We have tons of episodes about investing and real estate and entrepreneurship. It's a lot of fun. You can check that out as well.
Yeah. Okay, great. And anything else that we haven't covered as far as land and development that maybe a question that you were hoping I would have asked that I didn't ask?
Oh, man. No, you covered it. You were really, really thorough with everything. I can't think of anything.
Okay. Yeah, I appreciate that. Okay. I do have two other questions for you that I ask every guest. And the first one is, what advice you would give somebody who's maybe just starting out in their investment journey?
Pay for a mentor. Don't use your money to invest in deals. The best ROI I've ever gotten is when I've invested in me. So paying people for the coaching to not make the mistakes. The mistakes are what you want to avoid. So I would have definitely figured out specific people who I needed the mentorship from and paid them a lot faster than I did. I spent years figuring it out, and I don't recommend that at all.
That's great advice. How about a book recommendation? It doesn't have to be real estate related, but it certainly can be.
Yeah, I love the book 10X is Easier Than 2X. I love those guys. I love the title. For us, it really puts things in perspective. When you think about 2X, you think linearly. So I'm going to 2X my business. Well, where does your mind go? Oh my God, 2 times the employees, 2 times the phone calls, 2 times the headache, 2 times, and your brain just shuts down and doesn't buy into it. But if you say, I'm going to 10X things, well, all of a sudden you can't think linearly. You have to think exponentially. So what does that look like? Well, forget hiring people. I'm going to have to do partnerships with other firms that already have the people on staff. I'm going to have to go after investors that can write, 7-figure checks. I'm going to have to go after parcels of land that are not zoned for, 20, 30 units, but are zoned for 150 units. It forces you to think on how you would 10X rather than 2X. And so that's one that I've really enjoyed recently, that I'm still kind of on that kick because it did change our business. Since then, I did say, hey, look, sales team, no more of these 50 units or less. It's got to be above that. And they would bring these 30, unit deals to me. I'm like, nope, we're not even looking at it. Like, just focused on, 50, 100, 150 plus. And that alone will help us grow. So great concept.
Yeah, for sure. No, I love that one. That was a good one. All right. Well, thank you so much, Brandon. This has been great. I appreciate you being a guest on The Wealth Flow.
Thanks for having me, man. I enjoyed it.
Yeah.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.